In today's financial landscape, reducing home loan interest and paying off mortgages quickly is a goal many homeowners aspire to achieve. With the right strategies, you can significantly lower your mortgage costs and pave the way to financial freedom. One effective approach is to consider refinancing your mortgage to secure a lower interest rate. Additionally, making extra payments towards the principal can drastically reduce the overall interest you pay over the life of the loan. Understanding the importance of financial freedom cannot be overstated. By saving money on your mortgage, you can allocate those funds towards other investments, savings, or even enjoying life's little pleasures. Imagine the peace of mind that comes with knowing you're not tied down by debt, allowing you to focus on your future goals. Engaging in a quicker mortgage payoff not only enhances your financial stability but also opens up opportunities for wealth building. The sooner you eliminate your mortgage, the sooner you can invest in other ventures or enjoy a more comfortable retirement. So, let's dive into the strategies that can help you achieve these financial milestones and transform your home into a true asset. Understanding your mortgage. When it comes to home financing, understanding the different types of mortgages and interest rates is crucial for making informed decisions. One of the primary distinctions is between fixed-rate and adjustable-rate mortgages, ARMs. A fixed-rate mortgage offers a stable interest rate throughout the life of the loan, providing predictable monthly payments. This can be a great option for those who prefer consistency in their budgeting. On the other hand, ARMs typically start with a lower interest rate that can fluctuate over time, which means your monthly payments may vary. While this can lead to savings initially, it also carries the risk of increased payments in the future. Interest rates play a significant role in determining your monthly mortgage payments. Even a small change in the interest rate can have a substantial impact on how much you pay each month and over the life of the loan. Therefore, it's essential to stay informed about current rates and market trends. Encouraging viewers to review their current mortgage terms is vital. By understanding your mortgage structure and interest rates, you can make strategic decisions, whether it's refinancing for a better rate or adjusting your payment strategy to save money in the long run. Refinancing your mortgage can be a powerful tool for homeowners looking to lower their interest rates and reduce monthly payments. By replacing your existing mortgage with a new one, you may secure a lower interest rate, which can lead to significant savings over time. This is particularly beneficial if interest rates have dropped since you first took out your loan or if your credit score has improved, allowing you to qualify for better terms. However, it's essential to consider the potential costs associated with refinancing. While the savings from a lower interest rate can be substantial, refinancing often comes with fees such as closing costs, appraisal fees, and other charges. It's crucial to calculate whether the long-term savings outweigh these upfront costs. Encouraging viewers to shop around for the best rates is vital in the refinancing process. Different lenders may offer varying rates and terms, so taking the time to compare options can lead to better deals. Additionally, don't hesitate to negotiate with lenders to secure the most favorable terms possible. By being proactive and informed, you can make refinancing work to your advantage, ultimately leading to a more manageable mortgage and greater financial freedom. Making extra payments on your mortgage can significantly reduce the amount of interest you pay over the life of the loan. When you make additional principal payments, you lower the outstanding balance faster, which in turn reduces the interest that accrues. This means that more of your monthly payment goes toward paying down the principal rather than just covering interest, ultimately shortening the loan term and saving you money. To effectively budget for these extra payments, consider setting aside a specific amount each month or allocating any windfalls, such as tax refunds or bonuses, directly toward your mortgage. Even small amounts can add up over time, making a noticeable difference in your overall interest costs. Another effective strategy is to consider a bi-weekly payment plan. Instead of making monthly payments, you can split your monthly payment in half and pay that amount every 2 weeks. This results in one extra payment each year, which can significantly accelerate your mortgage payoff and reduce interest. Encouraging viewers to explore these options can empower them to take control of their mortgage and work towards financial freedom more quickly. By making extra payments, you can transform your mortgage into a stepping stone toward a debt-free future. Utilizing mortgage points. Mortgage points, often referred to as discount points, are fees paid directly to the lender at closing in exchange for a reduced interest rate on your mortgage. Each point typically costs 1% of the total loan amount and can lower your interest rate by about 0.25%, although this can vary by lender. By purchasing points, you can effectively decrease your monthly mortgage payments, making homeownership more affordable over time. While paying for mortgage points involves upfront costs, it's essential to weigh these costs against the long-term savings they can provide. For example, if you plan to stay in your home for several years, the savings from a lower interest rate can quickly offset the initial expense of the points. However, if you anticipate moving or refinancing within a short period, the upfront investment may not be worth it. Encouraging viewers to evaluate whether mortgage points are worth it for their specific financial situation is crucial. Consider factors such as how long you plan to stay in your home and your current financial goals. By carefully assessing these elements, you can make an informed decision that aligns with your long-term financial strategy and helps you save money on your mortgage. Improving your credit score. A better credit score can significantly lower your mortgage interest rates, making homeownership more affordable. Lenders use credit scores to assess your creditworthiness, and a higher score typically translates to lower risk for them. Factors that affect credit scores include payment history, credit utilization, length of credit history, types of credit accounts, and recent inquiries. Understanding these elements can help you identify areas for improvement. To quickly boost your credit score, start by paying down high credit card balances to reduce your credit utilization ratio. Making all your payments on time is crucial, as payment history is one of the most significant factors in your score. Additionally, consider becoming an authorized user on a responsible person's credit card, which can help improve your score by adding their positive payment history to your report. Encouraging viewers to check their credit reports regularly is essential. By reviewing your credit report, you can identify any errors or discrepancies that may be negatively impacting your score. You're entitled to one free credit report per year from each of the 3 major credit bureaus. Staying informed about your credit status can empower you to take proactive steps toward improving your score and securing better mortgage rates. The length of your loan term can have a significant impact on the amount of interest you pay over the life of your mortgage. The 2 most common options are 15-year and 30-year loans. A 30-year loan typically offers lower monthly payments, making it more manageable for many homeowners. However, this extended term means you'll pay more interest overall compared to a 15-year loan, which has higher monthly payments but allows you to pay off your mortgage much faster. Opting for a shorter loan term, like a 15-year mortgage, can lead to substantial savings on interest. Because you're paying off the loan in a shorter time frame, the interest rate is often lower, and you'll accumulate less interest over the life of the loan. This can result in thousands of dollars saved, allowing you to build equity in your home more quickly. Encouraging viewers to assess their financial goals is crucial when choosing the right loan term. Consider factors such as your monthly budget, long-term plans, and how quickly you want to be mortgage-free. By aligning your loan term with your financial objectives, you can make a more informed decision that supports your overall financial health. Reducing mortgage interest is a vital step toward achieving financial freedom and saving money over the long term. Understanding your mortgage options is the first key strategy. Knowing the differences between fixed-rate and adjustable-rate mortgages can help you choose the best fit for your financial situation. Additionally, utilizing mortgage points can lower your interest rate, while selecting the right loan term can significantly impact your overall costs. Refinancing your mortgage is another powerful tool that can lead to lower interest rates and reduced monthly payments. Coupled with making extra payments towards the principal, these strategies can accelerate your mortgage payoff and save you thousands in interest. As you explore these options, remember that assessing your financial goals and staying informed about your credit score are essential components of this journey. By spreading the word, you can help others take control of their mortgage and work towards a more secure financial future. Stay tuned for more valuable financial tips and insights that can empower you on your path to homeownership and beyond.